Welcome back, everyone, to another episode of Let's Talk Housing. My name's Brennan Thomas, and I'm the co-host here alongside Stephen Thomas, the founder and chief economist of Reports on Housing. So today we will discuss the most recent economic news and statistics, volatile mortgage rates, fixing the 2025 market, if there is a fix, how 2024 ended, and much more. But first, Stephen, what is going on in your amazing life?
This is a super busy season, as it is for everybody. But all of our holiday decorations are down, and that's fun. However, we run into the birthday season immediately after the New Year. We have Mason, your youngest brother, who is not actually youngest brother. There's always Zeke, your second youngest brother. He just had his 14th birthday on the 3rd. Then my wonderful wife's birthday was yesterday, and my birthday is next week. So it's just we go right from the holidays into a whole bunch of birthdays, and then after my birthday, we get a little bit of a break until we get to you know uh, Valentine's Day, and Zeke has his birthday next month. But this is the season that's super busy, but after my birthday we get a bit of a break. So that's what's kind of going on. It's like we're still in the holiday birthday celebration mode. The kids went back to school. They're running. We've got these horrible winds and all these fires, and from the fires that we had back in the past, over by where we are in South Orange County, all the there's tons of ash. It's just been raining ash. We have so much ash in our yard, and those fires were from a couple months ago, but we've had no rain, so it's just means that all that ash continues to blow our direction. So we have piles of ash all over the place. So kids are having a hard time with their sports because of all the ash, but the wind's supposed to stop today, and hopefully all those fires are under control soon. So, anyways, that's what's going on with us over here. How about with Mr. Brendan Thomas? What's going on in Brennan's world? Happy New Year.
Yeah, well, Happy New Year. I mean, I had fun celebrating all the holidays that passed and being able to take some time to really spend some time with family and friends. And it was very, very amazing. And then recently, I had the wonderful pleasure to go see a couple Ducks games, which is always so much fun. You and I have talked about that since the dawn of time, but it's that's just one of my favorite things to do down here. It's see those hockey games and live for that excitement, and just cannot wait until they're good again. I'm looking forward to maybe in a couple of years, but I keep my fingers crossed for maybe a blessing that we can make the playoffs sometime soon. That would be so much fun to see again.
Yeah,
Truly a blessing.
you sound a little bit like your brother Bryce. Yeah, in a couple years from now, they're always saying a couple years from now it will be they'll be good again. They'll be good again. We haven't made the playoffs in so many years. It's getting a little tiring. I usually grow a beard during the playoffs, but haven't my face has been as smooth as baby's bottom for years now going into playoff season. So can't wait for them to finally make the playoffs, and who knows when that will ever happen. I think they need a marquee star in order for that to happen, and they think they have it in some of this youth that Bryce, your brother, is constantly talking about, but I think they need to trade for a real marketable marquee star now.
You never know. We'll have to see. We'll
I
see how
agree.
the hockey market unfolds. Let's transition over to the real estate market. So, Stephen, what's going on in the real estate world with supply, demand, and our very own expected market time over the past couple of weeks?
Well, we're right now at that spot in the marketplace where it is all of a sudden it's pretty much stopped. We're at the start of the year, very start of the year. So when you're looking at the market right now, we're still in what I consider the holidays. There's still the holiday fog. It's not until we get about to the third week of January that the momentum really starts to build. we'll see more properties go under contract. And by the time we get to the end of January, you're going to see a lot more pending sales because the pending sales dropped to ridiculously low numbers, not only in Southern California, but across the United States. We have really low pending sales activity numbers because when you look back for the last month, that's the holidays, and we're still there. But what will happen is the pending sales activity will increase as the month progresses, and the New Year's resolutions will be all debunked by middle of January, and everybody will then focus again on purchasing a home. The issue with and then we go into the winter market from about mid January on. The issue with that is that there are not a lot of homes that come on the market. Yes, there are a lot more homes that come on the market than December, but December is the least number of homes that come on the market. We also have a number of unsuccessful sellers that throw in the towel. So the inventory levels have diminished down to a really low level. We'll get twice as many homes coming on the market for January compared to December, but that's still really low compared to where we will be during the spring. Really, homeowners like to place their homes on the market during the spring. If you ask many homeowners, that's what they say. And so you start to really see it in March, April, May, June, July, and some markets August, and May being the peak month for almost every market. So we're still at a very low number of homes coming to the market. Demand goes up. So what will happen is from here on out, yeah, it feels a little bit sluggish to start the year, but it will speed up as the month progresses. And it just depends upon how fast the market speeds up based upon interest rates. And we will talk more about interest rates, but right now we're kind of stuck above 7%. That's not where we want to be coming into the spring. So there's some economic reports that are going to come out that are going to be very telling. This week and next week are pretty critical.
So you touched on how at least this market could look going forward, but how did we start this year off, similar to what you just wrote about in our most recent report?
Yeah, so because of higher rates last year, we built an inventory that was higher than where we started last year. So the start to this year were higher inventory levels. Demand was a bit up higher slightly than last year, so more pending sales activity. But when you match the amount of homes on the market with the amount of with pending sales, even though there are more pending sales, which will result in more closed sales, which is what we saw, the issue is that there are way more homes than pending sales. So what we got is a little bit more sluggish of a market. We're not talking such a sluggish market where it's like stopped and it's a buyer's market or anything like that. Some markets could pivot towards that, and it all depends upon rates. But that's not quite where it's at yet. It's like a stay tuned kind of event.
So, Stephen, I wanted to touch on what has happened over the past couple of weeks with the economy since it's been, I guess, or since the holidays.
So not a whole heck of a lot. A lot of the numbers actually come in prior to during the first couple of weeks. There's some numbers that come out the third week. There are not that many numbers that come out the last week of December or the first week of the right around New Year's last week. So you have a couple weeks of not a lot of activity and not a lot of investment going on in Wall Street. A lot of people take the holidays off. So when you really can't even read into what's going on those last couple weeks and the first week of January. This is technically the real solid first week of January. And normally we would have had a jobs report last Friday, but they punted to this coming up Friday because of New Year's. So this is jobs week, way different than what we experienced last week. Last week was very little information. We got a initial jobless claims, and it came in lower than expectations. So there are no economic readings right now that are doing us any favors. And I'm sure we're going to get into it, but there are a lot of economic readings coming up right now.
So I wanted to ask you about bond yields since they've been all over the place. It seems Like a couple of weeks ago, we saw mortgage rates in the mid sixes, only from what it feels like, but now we're hovering above 7%. So I wanted to ask you, what is the reasoning? Why have bond yields and mortgage rates been so volatile over the past couple of weeks or a month or so?
So they were in the mid sixes, and then by the time we got to the middle of December, the economic releases that were coming out were a bit too hot, or where it shows a strong economy, a stronger economy than anticipated, and also a big pivot in the language from the Federal Reserve. Once the Federal Reserve came out and said what they said about, yeah, it's almost like it was an error, I would say, on the Fed's part. They don't know what to expect with the Trump administration. So even though they're not calling out the Trump administration, they pretty much did by saying that we don't know. We're gonna have to we're not gonna be doing as many, and we're just gonna have to wait and see. They have no idea where they're going. And it kind of reminds me of last year when all of a sudden when they were saying three rate cuts, and then they went down to one rate cut. And when they started saying that one rate cut, it almost made no sense. And that's this. And then they said there'll be four rate cuts for last year come September. So they were all over the place. And we knew that when they were talking in June that, man, it sounds like they don't know what they're talking about. Now in December, they're so unsure that nobody is for certain as to the direction of where things are going to go, because we haven't seen the Trump administration start. And I don't believe that they're going to be doing as many things that they're talking about. But if there right now, there's an article out, I think it was in CNBC, I can't remember, that there might be an economic it might claim an economic disaster and tariffs across the board. I mean, everybody's speculating as to what's going to go on. And until like a week from now, we're not really going to know, because that's where the rubber meets the road, is next week. But I don't think it's going to be as swift as everybody feels. And we're going to have to see how the overall economy behaves. And there's already a whole bunch of headwinds that were from 2024 that haven't gone away. So it's just, let's do this wait and see as to where things are headed, because and yes, we're stuck above 7% right now, but things can change on a dime. And like I was talking about earlier, that there's a lot of stuff, there's a lot of economic numbers that are coming out. Today is just a release of the Fed minutes, and that might move things because they are so unsure right now as to the path where they could go. They kind of feel like they have a soft landing, but they kind of feel there's some that are talking about a reigniting of inflation based upon the new administration's policies. There's a whole bunch of mixed chatter, so it'll be interesting to see what the Fed really had to say in the Fed minutes, so that that we can actually digest really what they're thinking in the room. And then this is jobs week. We had job openings. Job openings were higher than expectations, but they were last January too. And really, what's going to be key, I don't really care about the jobs opening or anything else. It's this Friday. It's Jobs Friday, and Jobs Friday is going to be huge, because Jobs Friday is going to tell us how many job openings there are, or how many, not job openings, but jobs were created, as well as where the unemployment rate is, and that can set the tone for the spring market. And then next week is also another pivotal week, because not only did we're setting the tone in with the jobs market, but we have we have CPI coming out. We have another manufacturing inflation read. So we have two inflation reads, and also on top of that, we get retail sales. So this week and next week are just action packed with a lot of economic data that we haven't seen for quite some time. So, and everybody is now done with the holidays and they're going back to work, and this week and for sure next week. And so there's going to be a lot of volatility. So all these economic reports can really establish where we're going to go for the spring, because once we have all these releases, we're stuck there pretty much for January. And if those releases are too hot, we'll be stuck above 7%, which will lead into February, and it will create more of a sluggish housing market. So that's why they will be very pivotal, because if they come in weaker than expectations, we could actually see interest rates float back into the sixes. Our base case was for interest rates to be between 6.5% and 7%. During the spring and summer. And there's still time to get there, but we're going to run out of time. If January is all locked in, now it's going to be February. And if we don't get good numbers for February, because if you remember last year, that's where we started seeing interest rates above 7% was in February. And then we were kind of stuck there. This is where we could start with these interest rates stuck above 7% in January, which would just not be a good initial start. We could get a reprieve in February, but it's all wait and see, because our base case might be between 6.5% and 7%. We made arguments for 6 to 6.5, but there's also, it looks like we're leaning now more towards that 7 to 7.5. So now it's between the 6.5 to 7% range, which would be great for the spring market, to the 7 to 7.5 range, which would not be good for housing in 2025. So it's kind of a wait and see how the economic data is going to come out. And that's a big difference, because I just read an article from a local reporter that was talking about, yeah, everybody makes such a big deal about rates and, watch rates and watch rates. You shouldn't watch rates. Actually, we watch rates because there's going to be a pivotal difference if we have rates below 7% because of the psychological factor. Anything in the sevens has a psychological factor. And I'm not talking about, I'm talking about 0 points in what the interest rates are if you go into the bank and you don't have to pay any points. And that is why we follow we follow Mortgage News Daily, because it's 0 points. Freddie Mac's, now all the news reporters, because it goes back to 1971, and we use it too, it's Freddie Mac's Mortgage Market Survey. Unfortunately, that's with 1 point. Not everybody, there's a lot of people paying points because it brings rates down, but when you walk into a bank and ask them what the rates are, you're not asking them after you pay a point. You want to know what the rates are today. So the headline rate is no points. And that's what I want to refer to. And that's the one that's stuck above 7%. And that's the psychological barrier that we have to address. If rates are too high, then we have a different market. If rates are below that 7% threshold with no points, it's going to make such a difference. So you have to be careful who you listen to in the articles, because a lot of them are quoting Freddie Mac's Mortgage Market Survey, but it's with a point. When we talk about this 7% threshold, it's with no points when you walk into your bank.
So I want to touch on that psychological barrier in just 1 second. But first, I want to clarify we are actually recording on publishing date, which is January 8th. So this week is job week, which is Monday, January 6th through the 10th. And chaotic week. We have a lot of stuff going on, and same as next week, which is the week of the 13th. How amazing is that? But so touching on the psychological barrier, we tend to call that at least the mortgage rate lockdown, which is what we talked about a bunch. And what I was going to ask you is will this still be an ongoing issue going into 2025?
Yeah, I'm not a big fan of the term mortgage rate lockdown. There's not a lot of people that are. It's more of hunkering down. And you understand the hunkering down effect is when you look at your monthly payment and you're considering making a move and you see how much more it's going to be because of how high rates are, it just prevents a lot of homeowners from saying, from making that move and saying, yes, I agree to do that. And there is a big difference from where we were in September at 6.1% to up to 7.1% today, especially in the high cost areas like what we have in California and in many high cost areas. But even for the people that aren't in high cost areas, it still makes a big difference on a monthly basis. So they just don't want to pull the trigger. So that is an issue where they're hunkering down saying, I don't want to move. The problem, though, is everybody's out there waiting for rates to come down. We've been waiting a super long time for rates to come down. A lot of people in the mortgage industry, and I actually had this as a joke, it was marry the house, date the rate. Man, that's a long-term dating arrangement that you have. It's pretty much kind of been permanent. We have not had a reprieve in rates. So the whole idea was, and we were in that camp where we thought rates were going to come down sooner. A lot of people did. And I can show you lots and lots of forecasts across the board that were saying lower next year, lower next year. And it's everybody's getting it now that, it looks like the United States economy is pretty darn resilient. We're not going to go into recession. It's not slowing down like everybody had originally anticipated. We thought the labor market would slow down a little bit more than it has, and that's been the sentiment across the board. So as a result, rates haven't come down. Now, the last time we had rates below 6%, that was August of 2022, and you look backwards, and that's a long time ago. A really long time ago. What are we at now? Is that, I can't even remember, how long ago is that? I was saying it's 28, now we're in January, so that's 29 months ago. That's a long time. It's getting further and further in the rearview mirror when the last time we saw interest rates in the fives with duration. And that was quite a different market way back then. We're stuck above this 6% threshold, and we've been there for such a long time. So people are just tired of waiting. And so there will be a lot of people that were saying, yeah, I'm just going to wait for rates to come down for when. There's a lot of life circumstances and a lot of different things and different plans that have been put on hold for a long time. And it comes to a point where people just say, all right, I'm going to place my home on the market. So 2023 was this low base of the number of people placing their homes on the market compared to prior to COVID. And prior to COVID, every year, almost the same number of homes come on the market every month. And you had a peak typically almost across the board in May. So things were coming, things were definitely, it's normal. It was up at the top of the chart is the normal number of homes that come on the market. Well, in 2023, we hit this all-time low across the board. There was far fewer homes that came on the market. Out of all the markets across the United States, San Diego County was home to one of the worst, where it was like 48% fewer homes compared to the 3-year average prior to COVID. So they're missing half of the normal number of homes that come on the market, which creates a supply crisis, which is why in 2023, San Diego County was the county that outperformed all other counties in terms of values rising. And then in 2024, there were more homes that came on the market than 2023. So that was a low threshold. And in 2025, there will be even more homes that come on the market. And it's just that when I do presentations all over the place, I ask anybody if they have an interest rate of 3% or less. And there are a lot of hands that go up. Then I ask those people that have their hands up, who is going to move within the next few years? And I was not getting any hands in 2023. In 2024, I started getting more and more hands. In 2025, there will be even more hands because it's been such a long time, 29 months since rates were below 6%. So people are just getting tired of waiting. So there will be more signs and yards and more homes that come on the market. Still will be muted compared to where we were prior to COVID, but slowly but surely it's making its way back to COVID the longer we remain at these higher rates.
So, with 2024 feeling like such a sluggish year, how can we go about fixing the housing market to make it a busier, faster paced marketplace?
Well, I think the answer is rates that are less than 7%. Last year, we were stuck above 7% for most of the year. We didn't get a reprieve until right around the midpoint of July, and then right around the start of October, it started to scream higher, and we got above 7% again in October. So there was this little time frame where we were below 7%, but it didn't match up very well. You need to be during the spring. That spring market to June is our start of our summer markets. Really, we say that spring runs from mid-March to the end of May. And then June is our summer market. And then it's part of July. Really, by the time rates were below 7%, it's kind of like the end of the summer. It's pretty done, because if you wanted to be a pending sale and close, you had to be in pending status by the middle of July, because by the time you got to the middle of August, kids are going back to school and summer's pretty much over. So that's the rates didn't match up the right time. This year, we need rates to be below 7% threshold from March through the middle of July, and that's going to be pivotal on whether we have a robust market. So it's that threshold, and that's what we're watching very carefully. It really makes a difference. You can see the difference in the pending sales statistics when we have rates below 7%, and I'm talking with no points, because if you add a point, you can get rates even lower, and it makes it, the lower that rates go, the better the market will be. So we will be watching how it lines up with the spring and summer markets.
So, unlike the summer of 2024, October and November saw large jumps in home sales. So, how could this be, and does this say anything as we enter 2025?
Yeah, it does, and this also, it kind of goes with the theme of today, and that theme of today is basically you need rates that are lower. So what we had was, we had rates that were working with the marketplace from August. Really, they were, by the time we got to August, they were really good. They were a lot better. They got to September, we got down to 6.1%, and even towards the end of the year, we got in below 7%. In December, the first half of December, we got below 7%. So it instigated some demand every time it gets there, and there are more homes available. So when you instigate more demand and there's more homes available, it's very, very easy to place that lagging inventory that's just sitting there, that stagnant inventory, and place into pending status. So we get these elevations in pending sales statistics. So we have year over year differences. It's higher. And so that's why we got to watch it very, very carefully. That was an indicator of how important it is that we're below 7%. And that's what fed into that, is because we had more homes available. Buyers were able to look around, had more choices. They haven't had choices in a long time. So they have more choices, and you have a little bit more of a favorable mortgage rate environment. And that creates more sales, which is what we saw towards the end of 2024. But keep in mind, right now, we're starting above 7%. So, and we're watching statistics. Yes, we're slightly higher demand readings, but there are more opportunities. There are more available homes. But we need those rates to cooperate for it to really add up to a lot more pending sales and a lot more closed sales. It's easy to do when there's a lot more homes that are available year over year. If rates get down enough, we're just going to see a lot more activity. If rates stay elevated, we could see year over year differences that are slightly up. But as somebody that deals with the real estate industry, it's been frozen. I'm rooting for it to thaw out, not for all the real estate agents and brokers and everybody else that's tied for it. That's super important, because they've been suffering for a long time. But it's also all the buyers, the people out there that want to buy, that haven't been able to buy because rates haven't cooperated, as well as the homeowners that would like to move but haven't been able to move because they're enjoying their low mortgage rate and they don't want to trade it in for a higher mortgage rate. That's why we need rates to cooperate. So, man, it's all boiling down to rates, rates, rates. Maybe that's the title of this podcast. Just kidding.
Active listings in November was 12.1% higher than they were in November 2023, and hit the highest level since 2020, according to a report done by Redfin. More than half of those homes, however, sat in the market for at least 60 days without going under a contract of sale. In comparison to before COVID, is this a scary statistic, or would you say that we are in the clear?
No, that's more. It's like, those are more normal marketplaces. Things shouldn't be flying off the market instantaneously. That's. I don't like to see things in the 20s or in the teens for how quickly things sell. We still are dealing with marketplaces where the median time on the market is still super low, and it's kind of ridiculous to watch. And yeah, there are homes that are stagnating, but that's because when you have interest rates that are higher, you have to be priced right. Have to be priced right. You don't get away with overpricing a home unless we had interest rates for a long period of time below 6.5%. That's our threshold. And the lower it goes, the more you can get away with overpricing, as we saw during COVID. People were overpricing and still getting their ridiculous prices. So we're going to watch that very, very carefully as to how things progress from here. But it's kind of what we see.
And what I wanted to ask you was how was the finish to 2024 in comparison to previous years?
Well, it was better than 2023, but it wasn't. It's still been very, very sluggish. We want the markets to thaw out. I want buyers to be able to buy and seller and homeowners to be able to sell. And there are more. It was nice to see rates down at 6.1%. It was below 6.5% rates for 42 days. That's not long enough. So it just showed you that easily we can get there. But I mean, I'm not super impressed. Slightly above 2023 levels is not like something to say, oh my gosh, that was fantastic. 2023 was a very, very low bar. So we beat that low bar. We just need rates to be lower in order for us to really beat the prior year, because the prior year is easy to beat. It's just that we've been stuck in these doldrums for such a long time that kind of getting used to these doldrums, that as soon as we have rates that do cooperate, the market's really going to just branch out. It's going to accelerate rapidly, and you know what? It still won't be as robust as it was during prior to 2023, and or even prior to COVID. It's not going to be robust like that until we finally get rates that are below 6%. But it's easy to, but we really crashed in the number of closed sales. It was like that crash that everybody was anticipating didn't come in prices. It came in the number of closed sales, because there aren't that many buyers that can afford to purchase. And people were saying, yeah, but there's still a lot of buyers. They were telling me this in 2023, and I was telling them that it seems like there's a lot of buyers, but there's just, the inventory's was so low at the start of 2023 that, you know what, those same buyers that were like, my example was this, that if you don't have that many homes in the market that are in an area and something does finally come up, and even though the interest rates are high, you still get like 10 buyers that are looking to purchase a home. And when they were all making offers on that one house, the prices were being kind of bid up a little bit, and only one person got it, and the other 9 people had to go off and wait for the next house that came on the market. Well, the problem was, as rates got higher, some of those buyers peeled off, and now you only had a few people. And because rates were stuck above 7%. And then slowly but surely, more homes were coming on the market last year compared to the prior year. And those extra homes that were coming on the market were adding to the overall marketplace. And so those 3 buyers that were able to, that were competing with each other, were all able to find houses. And now all the rest of the homes started to accumulate, and we got this accumulation of inventory over time. And that's where we're at today. There's not a whole bunch of buyers out there that can afford to purchase when interest rates are above 7%. And that's why we saw this high level of closed sales in 2021, 2022 first half, and then 2023, 2022 second half started to really cave. And then 2023, so you saw this threshold, this, like, it started to be this waterfall the second half of 2022, and that waterfall stayed at low levels for 2023, and that's where closed sales were. And in 2024, easy to beat that. I can't wait to see it come up. It's not going to be like where it was before, but it's definitely going to be higher than what we established in 2023 and 2024.
And to finish off this episode, according to Apollo Global Management, there's now a 40% chance that the Fed will pivot back to hiking rates again next year. So, Steve, is this a pessimistic point of view that they are predicting with?
Yeah, in my opinion, yes. Yes, absolutely. There would have to be a reignition of inflation based upon uh, presidential administration policies. Yet they're not gonna act blindly and do it all at once if that's what the end case is going to be. So there's all the economists are talking in their ears, and everybody has this big opinions. They're not totally got their ears plugged to this. They've been talking. They said a lot of stuff on the campaign trails. They'll continue to say a lot of stuff, but as far as the rubber meeting the road, which starts next week, I don't think it's all going to be executed all at once, or we really will have issues and we'll be in this lurch of an area where we have no idea where we're going. It's kind of the way the Fed made things sound in December when Jerome Powell made his speech. So it is pessimistic. It is not the base case that everybody's feeling. I think 40% is a bit high. That's not Wall Street doesn't agree with Apollo, but that's just one outfit's take. We'll have to see what everybody else thinks down the road as soon as these policies start ticking off. But there's a lot of people saying a lot of different things right now because there's nothing really going on yet. And there will be a lot going on. Just wait till next week, and we'll start by Friday. We'll see the jobs report. That'll be like the kickoff to 2025 and everything that goes on. And then we'll get the inauguration, and then we're also going to get inflation numbers, and we're going to get retail sales. So off to the races. We'll have more meat on the bone once this month gets underway. But right now, there's a lot of speculation out there, and I don't like to operate on speculation. I could put a percentage on it if you want. Let's call it like 5% chance that they do it. But that's almost what it seems like. It's almost like just a speculation, and somebody had a hunch. Yeah, I think it's a 40% chance. And they start talking about it and giving their arguments, and they come up with some random number. And I think it's a little bit on the ridiculous side right now. But we'll have to wait and see. We could be wrong.
Well, thank you everyone again for tuning in to another episode of Let's Talk Housing. If you want to learn more about what's going on in the real estate industry across Southern California, the Bay Area, Phoenix, or Las Vegas, feel free to check out our YouTube or subscribe today at reportsonhousing.com. Please leave us a good review. We'd always appreciate it. And if you have any questions, you can post it to anywhere on our social media, or you can email me personally at info@reportsonhousing.com. So we will see you soon, and have a fantastic rest of your day, and Happy New Year.
Happy New Year.